just a little bit about me. I am actually from Millbrae, California. I was born in San Francisco and raised in Millbrae on Anita Lane. My parents bought the house for about, I don't know, 28,000 back in 1962 when I was born. And I was raised there. I went to Cappuccino High School. I was a Peninsula girl. I now live in San Jose with my husband of 21 years. And I have to say that I really miss the peninsula, but I do go up there, on occasions. I was up there a lot when we sold my parents' home. So I came into this industry 18 years ago, both my husband and I as partners. The reason that I came into this industry was because I received that call from my dad stating that he and my mom were interested in doing a reverse mortgage. I had no idea what this product was, and I was worried. And my husband and I decided to, run up to Millbrae and sit down with a financial advisor, which was a friend of my dad's, and then an agent like myself. My parents owed 200,000 on their home, and the home at that point was worth about 785,000. So they had 585,000 in equity at that time. Retirement, they were able to stay in their home, which was their number one priority in life. Do not take me away from my home. They had a loan of 200,000. They had a nice line of credit that grew over time. That's one of the special features that the FHA reverse mortgage gives these seniors 62 and older. It's a line of credit increase that they can access in the future. So when my parents took out this reverse mortgage, I was a firm believer of this product, and I am here today to dispel all of those myths about this wonderful product. So my parents, sadly, over the years, my father became ill, and we needed to utilize that reverse mortgage line of credit, and we're very thankful that they had that line of credit so we didn't have to come up with the funds to pay for my father's care. We placed my father in a boarding care in San Bruno, close enough for my mom to go visit him. And sadly, we lost my dad in 2018. And we still had the reverse mortgage in place with my mom. So she was able to utilize some of that line of credit as she got older for in-home help, grocery shopping. She hired a driver. So she was starting to become more frail, and then she had a stroke right when COVID hit off at March 2020. When my mom had her stroke, we as children had a decision to make. So we utilized the rest of the reverse mortgage line of credit, and we helped with her care. We fixed up the house on Anita Lane in Millbrae, California. And then we sold the house. We had to place my mom into an assisted living because she had the highest level of care. But we were very thankful to have that reverse mortgage line of credit to assist them as they aged. We sold the house in 2021 for $2.25 million. The equity in the home way surpassed the 585 that my parents had 18 years ago. So my mom ended up much richer in equity when we sold the house in 2021. My mom has since then passed away, and my parents were always worried about leaving equity and leaving an inheritance for their three girls. And we were lucky to be able to achieve some of that inheritance when my mom passed away. Right now, I am working for a company called Traditional Mortgage Acceptance Corporation. We are a direct lender and we are fourth in the nation. We are a Ginnie Mae issuer. We service our own FHA reverse mortgage loans. And I'm very happy to be here because we service our own loans and I have more control over underwriting and processing where I stand. I have been originating this loan for 17 plus years and I love my job. This is a wonderful industry to be and in helping seniors that are older or older adults, I call them. So, one of the most frequently asked questions about a reverse mortgage is, will I lose my home? Does the bank own my home? No. It is a mortgage just like any other mortgage. I have a mortgage on my home. This is a mortgage on your home, except it's a reverse mortgage. Back in 1990, under the Reagan administration, the reverse mortgage was active ahead of the Reagan administration, and it was more of a bank future equity shared program. The government liked the idea of a reverse mortgage helping seniors stay in their home, but they didn't like the shared future equity program. So they took over this mortgage and they actually changed the name to Home Equity Conversion Mortgage. This is a FHA approved, FHA insured mortgage. Since they launched the home equity conversion mortgage, we now have something called the reverse mortgage for purchase, where you come in. And I have been getting more and more, I've been helping more and more seniors downsizing their homes to more affordable living, where you may have a client who is in their 80s and they have a large mortgage on their home that they can no longer afford. The home is too big and they want to downsize or move closer to family, but they still want to be able to own a home. The reverse mortgage for purchase is a wonderful avenue for them. There's no monthly payments. The reverse mortgage will put the down payment on their new home, and the client will take monies from the closing of their departing home and put down the rest of the money. It really is a wonderful, wonderful product that many realtors are not aware of. So if you have a senior, 62 and older, who are looking to purchase a home, either downsizing or just purchasing a home, a reverse purchase may be a wonderful solution for them. So yes, every day there are 10,000 people turning the age 65. And most of those people, age 65, have not fully prepared for retirement. And they have a lot of stress, and their only income is Social Security, but they're sitting on equity of their home. So it's stranded equity that the reverse mortgage may be able to take out from their equity to enhance their retirement. So if tapping into the equity can make sense for your financial situation. So if any of your clients or yourself have a retirement portfolio and you're starting to find that you need to withdraw from your retirement portfolio, but then taxes are put on those retirement funds, the reverse mortgage is tax-free income. And by borrowing from your stranded equity can make sense if you utilize this product as a financial strategy. This loan may give you a line of credit. That line of credit grows over time we're talking 6.5% to 7% today. So as you get older, it's worth more as you get older. And it's nice knowing that you have that line of credit available to you in the future in case you need it or for unforeseen circumstances. The reverse mortgage is different from a home equity line of credit. In some ways, it's similar because it gives you a line of credit. However, payments are not required. You can make payments on this loan if you want. There's no prepayment penalty, or you don't have to make payments on this loan. The loan doesn't come due until after you pass away or sell your home. Yes. So if utilized strategically, then this can be a large part of your retirement planning. Financial advisors are beginning to get whim of how this can be a useful tool as you age over time by not tapping into your retirement portfolio and using tax-free income through your home to provide you some financial relief. Now, there's something to think about, especially because we're in the state of California. Homes are appreciating faster than other locations in the United States, as you probably know. So as the home appreciates in value, just like the situation with my mom and dad, the home is appreciating faster than the loan balance. My parents' loan balance at the time, I forgot to mention, was 800,000. Why? Because they used a large portion of their line of credit. They had a loan to be paid off, and we utilized the rest of it for their care. The elephant in the room. So this is the reason I came into this industry because I personally thought it was a scam. I thought, okay, you're taking advantage of seniors. They're going to lose all of their equity and their children are going to be upset because they're no longer going to be able to get an inheritance. That is not true. The loan is a secured loan by the Federal Housing Administration. There's also jumbo reverse mortgages, which we could talk about. It is highly insured. It is a non-recourse loan, which means if the home, which I haven't seen in 17 years, if the home loses value tremendously and the loan balance raises, and let's say that they're upside down by 200,000, the loan does not come due. You pass away, the borrower passes away, and the heirs just walk away. The bank takes the loss. That's the non-recourse option, or not option. That is the non-recourse of the loan. They are well regulated and they are considered a wonderful financial solution as long as we utilize it strategically. When I work with a client, I look at their overall story. I encourage family members, financial advisors, or trusted advisors, friends and family that they trust, to join the conversation, go over the entire scenario, and I tailor the loan, the best loan that would suit their purposes for their retirement. What is the catch? So there is no catch. If you've heard that reverse mortgages are expensive, it's true because there's mortgage insurance on the loan. There's an upfront mortgage insurance premium that's financed into the loan, and some people consider that a catch, but it's a requirement because we have banks, we have lenders that are backed by FHA that are putting down a lot of money and access to a lot of money and not asking for repayment until the last surviving borrower passes away or sells the house. The balance will need to be repaid at some point, but not until the home is sold or the children, the heirs, decide to repay the loan through a refinance. So yes, so the reverse mortgage does convert a portion of the home equity into cash. We calculate this based on age and the national lending limit. The national lending limit is 1.2 million. Somebody who's 108 years old may reach that 1.2 million, but we use that as a standard of loan to value and age. So if somebody is 80 years old and their home is worth 3 million, we calculate based on the 1.2 million national lending limit. So somebody who is 80 years old, their benefit amount may be about 500,000. And that's if their home is worth over 1.2 million. That line of credit would be available to them if they do have a loan on their home that is required to be paid off. Once we pay that off, then whatever's left over in the benefit is pushed into a line of credit. And you do not need to make payments on this loan. You pay it when the loan is due through one of those events, either through passing away or selling the home. So you don't make monthly mortgage payments. However, the requirement is that you continue to pay your property taxes and homeowners insurance. We do have an impound feature, which we would set aside a certain amount that will pay your property taxes and homeowners insurance up until you're age 99. We need to make sure you live in your house as a primary residence. You can leave your house to go on vacation for 6 months if you want. They consider, however, if you leave your home for up to 12 months and 1 day, they consider that a change of residency. So if you come home on the 365th day and you spend the night at your home, it restarts the clock. There is really no FHA police that comes out to make sure that this is your primary residence. However, it does need to be your primary residence, and they will send you a form once a year asking if you are still in the land of the living and this is your primary residence. Okay, meanwhile, the balance of the loan is accruing interest. The negative part is that the loan will grow over time instead of going down over time. Why? Because you're not making payments. If you make payments, then the loan will go down. If you make payments towards the loan and principal and interest, you can certainly do that. We're about 6.5%. So we're in line with traditional lending interest rates right now on the FHA loan. So it will accrue interest over time. So it does compound interest over time. So the loan grows over time instead of going down. However, FHA tries to structure it where the appreciation of the home, hopefully, and especially in California, will surpass the negative part of the loan growth. So as long as we're still in a nice growth of equity and appreciation, then the reverse mortgage is a safe product for many seniors. The reverse mortgage actually is good for anyone 55 and older. The FHA is 62 and older. The jumbos, however, have lowered the limit to 55 and over. Now, if you're 55, your benefit amount is not going to be that of somebody who's 85, right? Because somebody who's 85, their life expectancy is going to be different from somebody who's 55. So with the jumbos, if you have a $3 million home and you're 55 years old, you may get a line of credit of 600,000. That's it. Where an 85-year-old may get a line of credit of $1 million. So it all depends on the age when it comes to the jumbo reverse mortgages. The jumbo reverse mortgages are ranging anywhere from 8.74% all the way surpassing 10%. We have fixed rates, we have line of credit, which are all variable rates, and we also have a Home Safe Second. The Home Safe Second allows borrowers to stay in their first mortgage, because many of us have low interest first mortgages, and allows them to have a second in a reverse mortgage, which is a wonderful product. The interest rates are about 9.74, and that it would be into a reverse mortgage where you do not have to make payments. You are not required to make payments, but you can if you need to. So to qualify, you need to reside in your home. You need to be age 55 and over. And there are different disbursements that you can choose from with a reverse mortgage. They're all different. The FHA, there's something called modified tenure. There's modified term. There's just the line of credit. And all of those, I usually work with the client and we tailor what is best and what their needs are. So again, the cash could be received either through a line of credit where you request funds whenever you need the funds. We can do a modified term, which means, for instance, I'm doing a loan in Menlo Park right now, and she needs the funds for in-home care. 50% of my loans are for in-home care funding. So we are doing a modified term. We're taking that line of credit of 400,000 and we're taking out 3,000 a month for the next 3 years and putting a separate, the remainder benefit into a line of credit so that she has access to additional funds. Plus, she is getting a monthly income for her in-home care. What happens at the end of the loan? The loan comes due when an event happens, either the death of the last surviving borrower, or if the borrowers decide that they want to move and downsize or move into an assisted living or move in with their children, which happens all the time. So the loan will come due at that point. Once the last surviving borrower passes away, the heirs have a decision to make. They could either refinance for the amount of the loan and keep the house, or they could sell the house and the loan gets paid out of escrow, just as if I was to sell my home today and my Bank of America loan would get paid out of escrow. It takes about the regulations are 6 months, that you have 6 months to either repay the loan through a refinance or sale of the property. In some cases, they give you 2 3-month extensions. What about the closing cost? That's a biggie. So the closing costs vary. With the FHA, there's a mortgage insurance premium, which is financed into the loan, which is the largest bulk of the fees. It is based on the national lending limit or lower. So if the home is valued at a under the national lending limit, then you have a 2% mortgage insurance premium on the property value. So if you've heard the reverse mortgages, like I said, are expensive, they are. The upfront mortgage insurance premium can be anywhere from $6,000 to $24,000, which is financed into the loan. And then there's closing costs, title, escrow, appraisal, recording, trust review, things of that nature, which I'm sure that you're familiar with. On top of that, there's some origination cost. And this is when I go into their current situation, what they owe on their home, and which is required for us to pay off, and we work out all of the details with the mortgage insurance, the origination cost, and the closing cost. Every borrower is required to be counseled by an FHA approved counselor with an FHA loan, and on the jumbo loans, same thing. The counseling session is typically $155. You could go in person or over the phone. The counseling is required. I am at arm's length. I provide a list of counseling agencies to choose from. And once you choose to make that appointment, the counseling is completed. It takes about 30 to 45 minutes. You want to make sure you understand the process, you understand the loan, and that this is a good solution for you. Once the counseling is completed, the state of California has an 8-day cool-off period, which means we cannot issue an FHA case number, start processing, underwriting, appraisal until that 8th day has gone by. You have the appraisal fee, which we do ask that you pay for up front, title and credit, and with credit report, the property inspection, not always required. The property inspections usually are not required for a HECM for purchase. I don't know why they have that in there. The reverse mortgage counseling and the FHA insurance. There are so many different ways to utilize this mortgage. It has been a true blessing in my own family's life. My parents were able to enhance their retirement. They were able to buy a minivan. Why? I don't know why my mom wanted a minivan, but she got a minivan. And they put a new roof on their home. They upgraded some things in their home. They went to Las Vegas a couple times. They really just wanted to go to dinner every night at Fiddler's or every Friday night at Fiddler's. And it really enhanced their life. And then it helped us as children when it was time for us to facilitate for them as they aged and became ill. We needed access to those funds as power of attorney to assist in keeping them in their home where they were comfortable. There are several different reasons why people apply for a reverse mortgage, and one is like I discussed for in-home care. The other option is I have seniors who have mortgages that they can no longer afford, and they don't want to leave their home, or they want to avoid capital gains taxes, which can be rather pricey in the areas that we live in. However, they were cash low and house rich and cash low. So all they had was is Social Security. They have a home that's worth $2 million. They have all this equity in this home, and they can no longer afford their mortgage payment. In most cases, we pay off the mortgage that they have on their home plus a HELOC, and we provide them with a line of credit to give them peace of mind knowing that they have access to some funds. So why not utilize their stranded equity in the home that they worked so hard to stay in and utilize those funds to give them peace of mind and a happy retirement? So that is just another reason why many folks are calling me for the reverse mortgage. And of course, the reverse for purchase. And for improvements. I just completed a loan. They wanted to enhance their backyard and front yard and pay for a few dental bills. And they were so happy when they were at the closing table. It's like, I'm so happy that we have access to these funds. We can work on our landscaping, put in a new bathroom. We can help our grandkids go to college. And, it really is a wonderful product, but we do have to be very careful. So I ask very serious questions from our clients. What are you using this money for? It's really none of my business, but in a way it is because I want to protect them. And there is, financial elder abuse out there. So we take into consideration everything, their entire story. And we need to be very careful because we need to make sure that they are making the right decision as a trusted advisor. You could pay for health care. You can maintain a line of credit with this reverse mortgage. Short-term medical emergencies and long-term care. I have completed reverse mortgages for people who are in debt, medical debt, from ambulance rides, for, like I said, dental care, vision. It has brought so much relief to so many people that are having health issues and really just want to stay in their home and avoid selling their home and paying high capital gains taxes. So it has been very educational to also the families like myself when I first came on board, learning about the reverse mortgage through my parents' experience. There are different programs. There are jumbos and there are FHA. The first one that you see here is the Home Safe. The Home Safe is a jumbo reverse mortgage. There's a Home Safe Select and a Home Safe Fixed. The Home Safe Select is a line of credit option, which is a variable rate. And these are loan amounts up to 4 million. So these are for higher valued homes. Now, since 2023, as you know, the interest rates had gone up. So the jumbo interest rates have climbed, where we were once at 4.99 for jumbo interest rate, 5.875. We're now in the 9s and 10s. So we have to be very choosy if this is a good solution for them in going into these higher interest rates. The HECM, also known as Home Equity Conversion Mortgage, is the FHA loan, where we are more in line in traditional lending at about 6.125%, 6.5%. The Home Safe Second is the new program, which offers a reverse mortgage that will subordinate behind your first mortgage. So many of us, age 55 and older, we have 30-year fixes that are 2.875 or 3.25, and we're okay making those payments, but we are either not qualifying for a HELOC because we're no longer working and we're retired and we don't have the income to qualify, or we simply don't have the funds to pay for a HELOC and to make payments. The Home Safe Second offers that flexibility into a reverse mortgage where you keep your first mortgage and you continue to make your payments, and the Home Safe Seconds allows you and gives you options for a second mortgage that you do not have to make payments on.
And Linda, what's the rate on that look like for the
The
Home Safe Second?
the Home Safe Second is 9.74. So this is just showing you the differences between a reverse mortgage and a traditional mortgage. Really, the number one thing is that you make payments on a traditional mortgage and HELOC, and you're not required to make payments on a reverse mortgage. But you can. If you come into winning the lottery or you come into an inheritance, you can certainly pay down the reverse mortgage. And like I said earlier, there's no prepayment penalty. And it is a non-recourse loan if it goes upside down, which I have never seen. The reverse mortgage process, education. So the first step is I usually meet with the clients and their trusted advisors or family. And we go over the process. I provide a packet with all the required information for counseling. And then you go into the counseling process. So you choose which counseling company would be the company of your choice. You pay the $155. Sometimes the counseling agencies get grant money where they are able to provide free counseling. Once you're counseled, then we go into the application. I usually have the borrowers start putting together items that I need, like bank statements and social security exhibits, living trust, because it will go through a trust review. And then we go next to the application. We could do an e-doc application, or we can meet in person and have you sign the application. After the application is completed, we issue an FHA case number, and then we start the processing and underwriting, and we order the appraisal. The appraiser will contact the borrower to make the appointment. There are a few things that we like to advise our clients on, and that is the carbon monoxide detector must be in the house in a living area. Smoke detectors, 2 straps on the water heater. FHA appraisers are looking for any kind of health and safety issue. If there's a leaky roof, plumbing issues, brush up against the house, which could potentially be a fire hazard, holes in the wall, things of that nature. After the appraisal is and the processing is done, we go into underwriting where they cross the T's and dot the I's. Then we get what's called conditions. Once we get the conditions, I usually contact my borrowers in case I need help with in collecting some additional items or tax returns, which is not that often. The tax returns are usually for adults that are still working and have their own business. Then we go to closing. Prior to closing, I contact the borrower and we go over different ways of taking the money. In selling a home that already has a reverse mortgage, it's important to know that title's going to call you and say, "Did you know that they owe 1.9 million on their home?" That's not true. We have to record 1.5 times the lending limit when we close a reverse mortgage. The loan is basically what the payoff demand says. Okay, so processing, appraisal, and then we go to closing. I think you could go to the next slide. Miss. So this loan isn't always of the last resort, honestly. I have clients that are my age in their 60s who are taking out the reverse mortgage. They have a paid off home just for that line of credit increase feature because that line of credit increase will rise at 7%. So if I get a line of credit of 300,000, when I'm 85 years old, that line of credit is going to be worth 700,000, which is invaluable in today's world. So it is not a loan of the last resort. If used utilized strategically, it can be one of the best mortgages you could ever apply for your future. You can't get kicked out of your house. As long as you pay your property taxes and homeowners insurance and you return the form once a year stating that you live in that house and that you're still in the land of the living. So if I stopped making mortgage payments on my home, it would go into foreclosure. This loan, you don't have to make mortgage payments, so it won't go into foreclosure. However, it can go into notice of default if you do not pay your property taxes or homeowners insurance. They do get red flagged of that. And you can sell your home. It's just like any other loan. It just gets paid out of escrow, just like any other loan. There are a lot of fees. That is true. There are. So it's not quite a myth, but they can be rather expensive. So can getting a HELOC or refinancing your home. There's fees. There's fees on any loan, any refinance, title, escrow, trust review. So you will always have fees when you finance or refinance a home. The kids say they get stuck with a huge bill. No. The heirs walk away. That's the non-recourse feature. If the home goes upside down, has not yet, since I've been in this industry, then the loan gets paid, the lender gets paid through the FHA insurance, and the heirs just walk away. So you can never owe more than what the home is worth. I heard that I can't leave my house to my kids. You certainly can. My parents left their home to us and we decided to sell the home. You can sell the home or you can refinance for whatever the loan balance is. So if the loan balance on your parents' home is 200,000 and their home is worth 1.5 million, pay off the 200,000 by just getting a traditional loan. But it's not safe. It's actually one of the safest loans you could possibly go into because it is government backed. Similar to a VA loan, it is a government backed with mortgage insurance and it is safe by enhancing those extra protections through the Federal Housing Administration. The financial assessment requirement, I see that in there. So in 2014, the FHA did put on what's called a financial assessment. We need to make sure that the borrowers have the ability to pay their property taxes and homeowners insurance with a leftover residual income. And we utilize that through whatever income they have, if it's Social Security, if it's pensions. Now, let's say there is a borrower who only gets $600 a month from Social Security, has a paid off home of $3 million. We utilize that line of credit and we dissipate that asset. So if they get a line of credit of 600,000 or 500,000, we dissipate that through our calculations, giving them a monthly income. We don't give them that monthly income, but for calculations purposes, we qualify them that way. Non-borrowing spouse. There are situations where you have a borrower who's 75 years old, and then you have a co-borrower or non-borrowing spouse who is 40 years old. That 40-year-old will not qualify for a reverse mortgage as a borrower, so they become what's called a non-borrowing spouse. They still have protection measures. If the borrower passes away, they can still stay in the home. The loan continues to grow, but that younger spouse does not have access to that leftover line of credit. But they could stay in the home until they pass away. Second appraisals, protecting against misappraisals of home values. There are times that we do ask for a second appraisal. We can contest an appraisal and do a reconsideration of value. It's rare that we get them passed, but there are times that our borrowers are, upset, over the value of their home. And I'm sure the realtors come across this as well. When they said that they were going to list my parents' home for 1.7 million, I'm like, their home is worth so much. But we did get 2.250 for the house. So it was a strategy that you realtors have. So, yes, so we do sometimes require second appraisals, and those second appraisals usually come through a jumbo reverse mortgage. If the home is valued at over 2 million, we are required to get a second appraisal, and we lend based on the lower of the two.
And I think, Linda, this chart was interesting to me when I saw it because reverse mortgages can get a bad rap, but I think you can see here just in the last less than 20 years, a lot of protections have been put in place. So I think that that helps to
Right.
assure
So when the
people.
government took over, like I said, they liked the idea of helping older adults stay in their home
Mhm,
and be comfortable, but they didn't like the Shared Future Equity program because it did eat up a lot of the equity.
mhm,
So they created this formulation where, you can only access a certain portion of your equity to have some equity preservation, not
mhm.
only for yourself, but for your children, for yourself if you want to sell and downsize, or for your children if you're worried about, leaving them an inheritance.
Is there a drawback? Because you mentioned that you do have some friends who are actually getting the, even if they're not using it yet, just getting the reverse mortgage, as a line of credit that will grow over time. So is there a drawback to doing that? Like, why would everybody not, if you're in your 60s, not go out and get a reverse mortgage if you have equity?
A lot, part of my job is to bringing the awareness of this product, and
Mhm,
it's just there's not a lot of us out there bringing out this awareness. It is such a valuable tool for anybody in their 60s who are interested in securing their future and having access to funds in the event of unforeseen circumstances. The downside is there's cost, right? So the upfront cost can be high. However, the benefit of that cost I feel outweighs that cost. The
mhm,
benefit is that you are securing your future with a line of credit that is growing at 6.5% and 7% in today's world. And you really can't get that right now with your investments. So having that is invaluable as you get older. So you don't have to ask your children for money if you need help or sell your house. You'll have access to those funds if you need it for in-home care, or if you want to enhance your retirement, or if you need to upgrade your home, or you just need help. So it's really a wonderful tool for anyone who is 62 and older. Now, if you're 62 and you have a high mortgage, it may not be the best program for you. But if you're in a situation where you can no longer afford your mortgage
mhm.
and you feel like you do not want to leave your home, you have to stay in your home, you love your home, this is where you raised your family, and you want to avoid capital gains taxes, the reverse mortgage may be able to pay off that mortgage and alleviate some of that stress.
Right. And how about you mentioned that it needs to be your primary residence. So,
Yeah.
in many cases for, older homeowners or parents, you can have situations where they might go to a care facility and then end up coming out, and they're not really so that, they're not sure if they're going to be there for a long time or just be able to go
Right.
there and maybe get better and come back to the house. So, how does all of that work?
Okay, so a couple things. So if it's a spouse situation, if there's two borrowers and one takes ill and needs to go into an assisted living, the loan is still secure. If there's one per borrower and that borrower, has a medical event and is in the hospital and needs to go to a rehab for a hip repair or rehab, or that is fine as long as this home is considered their primary residence and they're not outside of their home for over 12 months. If they're outside of their home for over 12 months, the loan is considered due. However, there are, ways to communicate with the lender if you're only in a rehab situation and you plan on coming back home.
So
Yeah.
thank you very much for being with us today.
Jean,
I'm
thank you
gonna
so much. I really appreciate you thinking of me. When it comes to this program, I'm extremely passionate about this program because I'm a walking testimony to it.
That totally shows. So I'd love to be able to do that, and I would love to help to keep getting the word out on these because it's just there's so many. Just looking at that list of all the ways in which you can utilize a reverse mortgage, and that's why we called the seminar opportunities because there's so many opportunities available with them. So thank you
And
very much.
there's no harm learning about it, just to learn
Right.
about it and
Yep.
to see how it may help your loved one.